Thank you. Thank you so much, Mr. Chairman, and so welcome, Chair Yellen. I am so pleased you're here today for this important and timely discussion. I look forward to your testimony in advance of the Federal Open Market Committee's meeting, at which you will decide whether or not to raise the federal funds rate. I am interested in hearing your perspective on the following issues and others. What current trends do you find most important in helping you assess the short and long-term challenges facing our economy? Secondly, how can the Federal Reserve time future rate increases so we don't jeopardize the current economic recovery or hurt American families? Thirdly, what do you think of the legislation recently passed by the House of Representatives that would compromise the independence of the Federal Reserve? Before I turn to these issues and others, I think it's important to put this hearing in perspective. At the end of the Bush administration, just a little less than 7 years ago, we faced what former Fed Chairman Bernanke called, and I quote, "the worst financial crisis in global history, including the Great Depression," end quote. We have come a long way since economic crisis, and that progress is in no small part due to the bold actions by the nonpartisan, non-political Federal Reserve. In the month when President Bush left office, we lost almost 820,000 private sector jobs. Over the past year, we have gained an average of 226,000 jobs per month. In fact, we've added 13.5 million private sector jobs over a record-breaking 68 consecutive months of growth. I have this chart, and I'd like to put it in the record, which explains and documents this growth. In October 2009, unemployment reached 10%. Since then, it has been cut in half. It now stands at 5%. There were about 7 unemployed workers for every job opening in July of 2009. Now there are 1.4 unemployed workers per job opening, the lowest this ratio has been since early 2001. Real GDP fell 4.2% between the end of 2007 and the second quarter of 2009. But GDP has increased by more than 14% since then. Growth has been positive in 23 of the last 25 quarters. Average home prices dropped 19% between 2007 and 2011, but now they're back up to where they were in 2007. About $17 trillion in wealth evaporated between the summer of 2007 and the beginning of 2009. All of those losses have been recovered, and now total wealth is about $10 trillion, higher than it was at the onset of the financial crisis. The Federal Reserve played an extraordinary role turning around the economy. It quickly acted to lower rates to almost zero and has held them there for about 7 years, which has been a principal factor in our economic recovery. The Fed did this despite the opposition of those who claimed that inflation was on the horizon and who were later proven wrong. Then, having exhausted the conventional tools of monetary policy, the Fed deployed several rounds of quantitative easing aimed at keeping long-term rates low and further stimulating our economy. These efforts helped haul our country out of the depths of the Great Recession. But without the Fed's actions, things would be very different today. A recent study by economists Alan Blinder and Mark Zandi found that efforts by the Federal Reserve and the Obama administration, with support from Democrats in Congress, dramatically reduced the severity and length of the Great Recession. Specifically, the report found that without their joint efforts, the recession would have lasted twice as long. The unemployment rate would have reached nearly 16%, and we would have lost twice as many jobs, more than 17 million American jobs. I'd like to enter the Blinder-Zandi report into the record. Ironically, Republicans in Congress made recovery more difficult. As former Reserve Chairman Ben Bernanke wrote in his new book, which I recommend, and I quote, "The economy needed help from Congress. If not from additional spending on roads and bridges, for example, then at least in areas such as retraining unemployed workers," end quote. But the Republican-led Congress demanded deep spending cuts at a time when we needed aggressive fiscal policy to boost the economy. They ended up doing more to hurt than to help. And now Republicans complain that the economic recovery has been too slow. Now they have gone to one step further. 2 weeks ago, Republicans in the House of Representatives passed, in my opinion, damaging legislation, the FORM Act, that would fundamentally hamper the Fed's ability to conduct monetary policy. It would hurt the Fed's independence, for example, by forcing it to determine target interest rates using a mathematical formula, while ignoring a broad range of important economic indicators. Chair Yellen, as you have noted before, if the Fed had been forced to follow such a rule in recent years, and I quote from you, "Millions of Americans would have suffered unnecessary spells of joblessness over that period," end quote. If the FORM Act had been a law during the time of the recession, the Federal Reserve would not have been able to take the aggressive steps needed to help pull our nation out of the greatest economic crisis since the Great Depression. I hope today that we can focus on the critical issues before us, how the Federal Reserve should act to strengthen our economic recovery. But if necessary, we must clearly show that efforts to hamstring the Federal Reserve are misguided and dangerous. Chair Yellen, thank you for appearing before the Joint Economic Committee today, and I look very much forward, as always, to your testimony. Thank you so much. Thank you so much, Chair Yellen. In the speech you gave yesterday at the Economic Club of Washington, you said, and I quote, "Many FOMC participants indicated in September that they anticipated, in light of their economic forecast at the time, that it would be appropriate to raise the target range for the federal funds rate by the end of the year," end quote. What are the longer-term trends that would give you the most pause when deciding the timing of liftoff? For example, how will you assess tomorrow's jobs number in the context of its long-term trends?
Well, I think the two things that we focus on most in our evaluation are economic developments that affect the labor market and also those that affect inflation, because our congressional mandate calls for us to achieve maximum employment and price stability. And therefore, in my testimony, I tried to indicate that I do see there are ups and downs. Every series is noisy. We will be looking, of course, carefully at tomorrow's jobs report. What we're looking to see is a continued solid trend of job creation that, while we're close to full employment or maximum employment, at least to my mind, there remains some margins of slack in the labor market. Part-time involuntary employment remains too high. Labor force participation is on a declining trend, but nevertheless, I think it is to some extent depressed by the fact that the job market hasn't been stronger. So we want to see the economy being on a path where we'll continue to erode that labor market slack over time. So we'll be looking very carefully at that. But we can't overweight any particular number. We need to be looking at underlying trends in the data and not overweighting any number. Inflation is also clearly very important. We articulated several years ago that the committee has a 2% inflation objective. Inflation has been running significantly below that for some time. Just as we don't want to see persistent inflation above our objective, we also don't want to see persistent inflation below our 2% objective. So as I discussed, I think much of it is transitory, but we will be looking at data to see if our expectation that it's going to move up over time will be realized, and those are key pieces.
Chair Yellen, 2 weeks ago, the House passed legislation that would interfere with the Fed's operations in numerous ways. You wrote a sharply worded letter to congressional leadership expressing your opposition to the bill, and I request unanimous consent to place that letter in the record.
Without objection, we will do that.
And you said, and I quote, that it would, quote, severely damage the U.S. economy were it to become law, end quote. Could you describe why you believe that this legislation would be so damaging to the independence of the Fed?
Thank you. Just briefly, this legislation would force the Fed to set monetary policy according to a simple rule, something called the Taylor rule or a variant of it, that would tie short-term interest rates to only two economic variables, the current level of inflation and the current level of output. And while such rules are useful as reference points in thinking about monetary policy, to set the federal funds rate in that way without deeper analysis of what's appropriate for the economy would be extremely damaging. At this point, that rule would call for a federal funds rate well over 2%. And while we might be close to the point at which we should be raising it above zero, I think that if we were to follow that rule, it would be damaging. But maybe more important, I want to say that this is an approach to monetary policy that severely threatens the independence of the Federal Reserve in making decisions free of short-term political pressures in the best long-run interests of the economy. It would subject us to regular GAO audits of our monetary policy decision-making in a way that Congress has decided repeatedly and over many years it's wise to insulate the operational decisions of the Federal Reserve from those short-term political pressures. And I believe that almost all countries around the world have independent central banks. They've recognized it leads to stronger economic performance, and I believe this would be a step in interfering with the independence of the Federal Reserve in conducting monetary policy.